Iran versus America war. Major shock to exchange rates. Dinar and global markets react with an intro for your channel RV News. Welcome back to RV News, your trusted source for breaking developments, critical financial updates, and everything related to the revaluation of the Iraqi Dinar, Vietnamese Dong, and other emerging market currencies. Today we're diving into a deeply serious and urgent global topic: the escalating tensions between Iran and the United States, and how this growing conflict is sending shockwaves through the global economy, especially in the foreign exchange markets. If you're holding IQ, DVND, or other currencies in hopes of revaluation, or if you're closely watching global markets, this is an update you cannot afford to miss. So, let's unpack the latest intel, the real-time reactions, the potential future scenarios that may impact your financial strategies moving forward. Over the past 48 hours, global headlines have been dominated by the news of direct and escalating military conflict between Iran and the United States. What began as targeted strikes and retaliatory measures has now evolved into a broader confrontation involving airspace violations, regional proxy escalations, and direct military deployments. With American aircraft carriers now stationed in the Strait of Hormuz and Iranian missile batteries locked on key U.S. bases in the region, the situation is deteriorating rapidly. But beyond the tanks, missiles, and fighter jets, there's a hidden front line: the global financial system, particularly the foreign exchange markets. Almost immediately after the conflict became public, we saw massive market volatility. The US dollar, traditionally viewed as a safe haven currency, initially surged as investors rushed to seek security. However, as the depth of the conflict unfolded and fears of prolonged warfare emerged, the dollar's strength began to wobble. Investors started shifting assets into gold, oil, and certain regional currencies with anticipated advantages in a high oil price environment. Meanwhile, other currencies, including the Iraqi Dinar, have shown surprising and complex movements. Let's talk about those specifically. The Iraqi Dinar has always been at the center of speculation, investment, and revaluation hopes. With Iran as Iraq's neighbor and a key player in its political and economic landscape, this conflict has immediate ramifications for Iraq's stability and monetary sovereignty. Initially, the IQD saw a sharp dip in demand across black market and unofficial exchange channels due to fears of regional destabilization. But, curiously, there has also been renewed chatter from within Iraq's central financial institutions about economic independence and moving away from Iranian energy reliances, especially in electricity and gas. That narrative has caught the attention of many global investors. If Iraq can use this moment of crisis to assert itself economically, perhaps even push further toward international monetary compliance, it could be a precursor to long-anticipated reforms, including changes in the exchange rate mechanism. That said, the risk remains extremely high. If Iran's influence in Iraq intensifies due to the US-Iran war, it could delay or derail any plans for IQD reform or revaluation. Investors holding dinar are being urged to stay vigilant, diversify exposure, and monitor both Baghdad's policy decisions and Washington's next military steps. Now let's talk about oil. With the Strait of Hormuz accounting for roughly 20% of global oil transit, any disruption there sends oil prices soaring. This is exactly what we're witnessing. Crude oil futures are up over 15% in just a few days, and some analysts are predicting a $130 per barrel scenario if the conflict drags out. While this is bad news for oil importing countries, this could be seen as a silver lining for oil exporting economies like Iraq. A rise in oil revenues might give the Iraqi government more fiscal space to support its currency and reform monetary policy. However, this would only hold if the infrastructure remains intact and oil exports aren't physically disrupted by regional instability. As oil prices surge, so does inflation risk, particularly for developing countries. The Vietnamese Dong, another major currency of interest for revaluation watchers, has remained relatively stable but is under new pressure. Vietnam is a manufacturing powerhouse and relies heavily on imports of energy and raw materials, rising. Oil prices will increase input costs, potentially weakening the dong in the short term. However, Vietnam's strategic geopolitical position, trade relationships, and efforts to internationalize the dong could help cushion the blow. Experts suggest that Vietnam may accelerate agreements with BRICS and regional financial frameworks to shield itself from US dollar dependency during global instability. Back to the US dollar, it is no longer the infallible fortress it once was. While still dominant, its position as the global reserve currency is under serious scrutiny as geopolitical conflicts escalate and as BRICS nations, including Russia, China, and now potentially Iran, push for de-dollarization. The idea of a multipolar currency world is gaining traction. If the Iran-US war persists, more nations may start shifting reserves into gold, alternative currencies, or digital assets. This trend could weaken long-term confidence in the USD and elevate the strategic importance of other currencies, potentially including the IQD and VND if they are tied to gold or supported by commodity-backed frameworks. Another unexpected development comes from central banks around the world. Central Bank of Iraq, CBI, has reportedly begun internal discussions around reserve diversification and currency protection mechanisms. Leaked reports hint that a possible contingency plan includes an emergency revaluation strategy if regional currencies begin to collapse or lose credibility due to war spillover. While we haven't seen official confirmation, the mere existence of these discussions indicates how seriously Iraq is preparing for regional economic fallout. It also keeps the dream alive for those awaiting the dinar revaluation. Meanwhile, the global stock markets are in chaos. The Dow Jones Industrial Average has dropped over 1,000 points in the past 2 trading sessions. Asian markets are showing similar weakness, especially Japan and South Korea, which have close economic ties to both the US and the Middle East. European markets are also bracing for a recession-like scenario if energy prices spiral further out of control. Investors across all sectors are rebalancing portfolios and moving toward war-proof assets, gold, commodities, select real estate, and defensive stocks. Currency traders are watching everything like hawks. Let's not forget digital assets. Cryptocurrencies, especially Bitcoin and Ethereum, are experiencing a resurgence as confidence in traditional fiat systems wavers. BTC surged past $70,000 again, with many analysts suggesting a new role for Bitcoin as a geopolitical hedge. If this becomes the new norm, we could see a significant shift in how global capital flows are managed. Some rumors even suggest that regional governments, including Iraq and Turkey, are exploring the use of blockchain for cross-border payments in the event that SWIFT access is compromised due to sanctions or war escalation. While still speculative, its direction signals a potential sea change in financial systems. Let's shift gears and examine the psychological and political aspects. Wars not only affect markets, they shape them. Public sentiment, investor confidence, and political stability all influence currency values. If the U.S. domestic population turns against prolonged engagement in the Middle East, we might see political pressure that influences fiscal and monetary policy, potentially weakening the dollar. On the flip side, if the U.S. government gains bipartisan support for its military actions, it could embolden economic moves such as new sanctions on Iran or pressure on its allies. Moves that would again ripple through the currency landscape. 1. Particularly concerning scenario is the possibility of sanctions spiraling out of control. If the U.S. imposes secondary sanctions on countries trading with Iran, including Iraq, it could trap Iraq in a difficult position, economically penalized if it cooperates with Iran, but politically vulnerable if it distances itself. Scenario would increase currency volatility dramatically. If CBI then revalues the dinar under pressure, it might do so quietly, through internal mechanisms or contract-only platforms. This is why dinar holders need to remain extremely alert for any sudden CBI announcements or foreign exchange updates. At the same time, China and Russia are playing quiet but significant roles. China, as Iran's largest oil customer, could use this conflict to its advantage, securing energy at discounted prices while pushing the yuan as an alternative trade currency. Russia, already in conflict with the West, may provide logistical and intelligence support to Iran, further complicating the geopolitical web. Both nations are known to accumulate gold and diversify from the dollar, strategies that influence how their own currencies move and how others, like the IQD or VND, might align in a future multipolar monetary world. As we look ahead, there are three critical timeframes dinar and dong holders should focus on. The short-term 0 to 3 weeks expect extreme volatility rumor cycles and possible flash crash or flash spike events in currency trading platforms. The midterm 1 to 3 months. Watch for oil price stabilization or escalation, CBI policy announcements, and any coordinated financial responses from the IMF, World Bank, or regional alliances like BRICS. The long-term 3 to 12 month